The Nasdaq 100 moves fast. It can swing hundreds of points in a single session, and for retail traders, it is one of the most tempting markets in the world and one of the most unforgiving. So before you put a single dollar on the line, here is what you actually need to understand. The Nasdaq 100 tracks 100 of the largest non-financial companies listed on the Nasdaq exchange. Think Apple, Microsoft, Amazon, Nvidia. It is heavily weighted toward technology, which means it reacts sharply to anything that affects that sector. Earnings reports, interest rate decisions, inflation data, regulatory news. Most retail traders access this index through CFDs, contracts for difference. When you trade a Nasdaq CFD, you are not buying shares in any of those companies. You are entering an agreement with your broker to exchange the difference in price between when you open a trade and when you close it. You can go long if you think the index will rise, or short if you think it will fall. The key mechanic here is leverage. Leverage lets you control a large position with a relatively small deposit, called margin. That sounds attractive, but it cuts both ways. A small move against you can produce a loss far larger than the capital you put up. This is not a warning to be skimmed past. Most retail traders lose money trading leverage products. Only trade what you can genuinely afford to lose. Now, what moves the Nasdaq? Two things drive it more than anything else. First, earnings season. When major tech companies report results, the index can gap sharply in either direction. Watch the earnings calendar. Second, the US Federal Reserve. When interest rates rise, growth stocks, which dominate this index, tend to come under pressure. Keep an eye on rate decisions and inflation data. On the technical side, most active Nasdaq traders use a combination of moving averages, RSI, and support and resistance levels. No single tool gives you the full picture. Look for confirmation from more than one source before acting. The most volatile periods are around the US market open and close, 9:30 to 4 Eastern Time. That volatility creates opportunity, but it also creates risk. Risk management is where most traders fail. Before any trade, define exactly how much you are willing to lose. A common guideline is no more than 1 to 2% of your account on a single position. Use stop-loss orders to cap your downside. Size your positions based on the distance to your stop, not based on how confident you feel. If you are new to this market, start on a demo account. ZenithFX.com offers a free one with realistic pricing. Treat every demo trade as if it were real. Follow your rules. Review what worked and what did not. That habit, built before you risk real money, is worth more than any single trade you will ever take.